Most investors have never heard of this, but there's an entire corner of Wall Street where everyday people quietly collect 8%, 9%, even 10% plus annual income without owning a single rental property or chasing meme stocks. It's called the world of closed-end funds. And once you understand how they work, you'll realize why Wall Street would rather you keep buying low-yield index funds instead. The 8% check portfolio. Imagine this. You open your brokerage app on the first business day of the month, and there it is, another cash deposit. Not from your job, not from a side hustle, but from a portfolio paying you the equivalent of 8% or more per year in distributions. If your account was $200,000, that's around $16,000 a year in income, roughly $1,300 per month. At $500,000, you're talking about $40,000 a year, enough to cover a mortgage, groceries, and maybe even a couple of flights each year. Now here's the twist. These payouts aren't coming from some exotic crypto scheme or risky option strategy. They're coming from a structure almost nobody outside of serious income investors ever talks about. Closed-end funds, or CEFs. Stay with me, because in this video, we'll break down what closed-end funds are and how they quietly generate such high yields. The discount trick that lets you buy $1 of assets for 93 cents. The real risks Wall Street never mentions in the sales pitch, and how a regular American could use CEFs to build a monthly income stream. And toward the end, I'll give you a simple checklist you can use before you touch any high-yield fund with your hard-earned dollars. If you've ever looked at your 1.5% dividend ETF and thought, there's no way I'm retiring on this, this video is for you. What closed-end funds actually are. Let's strip away the jargon. A closed-end fund is basically a basket of investments, stocks, bonds, preferred shares, loans, munis, managed by a professional team. That sounds a lot like a mutual fund or ETF, until you look at the structure. Here's the key difference. A mutual fund creates and destroys shares every day as money flows in and out. An ETF does something similar through big institutions. A closed-end fund raises a fixed pool of money at launch through an IPO, and then closes the door. After that, its shares just trade on an exchange like a regular stock. That closed structure is not just a technical detail. It's the foundation for the income secret. Because the fund doesn't have to sell assets to meet daily redemptions, managers can invest in less liquid, higher-yielding stuff like certain bonds, loans, or niche strategies. The fund can also use leverage, borrowing money at lower rates, to buy more income-producing assets. In plain English, CEFs are like income machines bolted to the floor. Capital isn't constantly flowing in and out, so the managers can focus on squeezing out yield. The yield. Where does 8% plus come from? Let's talk numbers because that's what got you to click. As of late 2025, the average listed closed-end fund in the US was throwing off around a 9% distribution rate. Equity CEFs were around 8.6%, taxable bond CEFs roughly 11.5%, and some business development companies, cousins in the same high-income universe, were showing yields north of 12%. That's not a random outlier. That's the average across the sector. So how do they get there? 3 big levers. Higher yield assets. Many CEFs buy things like high-yield corporate bonds, bank loans, preferred stock, or niche equity strategies designed for income. These naturally yield more than basic S&P 500 index funds, or Treasury ETFs. Leverage. This is the turbocharger. A CEF can issue preferred shares or borrow at institutional rates, then use that borrowed money to buy more income-producing assets. If they borrow at, say, a lower rate and invest in securities yielding more, the spread flows through to shareholders. Discount pricing. Here's where it gets interesting. Because CEF shares trade on an exchange, the market price can be below the value of the underlying portfolio, what's called net asset value, or NAV. If the assets are worth $10 per share, but the market is only willing to pay $9.30, that's a 7% discount. Now imagine that fund pays 80 cents a year in distributions. At NAV, that's an 8% distribution rate. But at a $9.30 market price, the distribution rate to you is closer to 8.6%. You're effectively getting more yield because you bought the assets on sale. This is one of the few places in public markets where you can literally buy $1 of professionally managed assets for less than $1 and get paid 8 to 10% a year while you wait. The secret sauce: discounts, premiums, and investor psychology. Let's dig into that on-sale part because this is where savvy investors quietly make a lot of extra money and where uninformed investors get burned. CEF shares trade based on supply and demand, not just the value of their underlying holdings. That means sometimes funds trade at a discount to NAV. You pay less than the portfolio is worth. Sometimes funds trade at a premium. You pay more than the portfolio is worth. On average, traditional CEFs in late 2025 were trading around a 6.9% discount, wider than their 25-year average of about 4.9%. That means the whole space was cheaper than usual. Here's why that matters. Discounts and premiums are cyclical. Over time, a fund's discount or premium often drifts back toward its own historical average. That means if you buy a solid fund at an unusually large discount, you can get a double benefit: high distributions plus a potential bonus return if the discount narrows. Quick example: Fund A has assets worth $20 per share NAV. It trades at $18 per share in the market, a 10% discount. It pays $2 per year in distributions. At NAV, the distribution rate is 10%. At the $18 market price, you're collecting roughly 11.1%. If, over a couple of years, that discount narrows from 10% to, say, 3%, your share price could move up even if the underlying portfolio only does okay. Wall Street loves selling you products at full price. CEFs are one of the rare places where patient investors can shop the clearance rack of yield, if they know what to look for. The catch: what Wall Street doesn't emphasize. Anytime you see 8 to 12% yields, your first thought should be, what's the catch? You're right to be suspicious. And there are real risks that come with closed-end funds that a glossy brochure won't spell out. Here are the big ones. Leverage cuts both ways. The same borrowing that boosts your income also magnifies losses. If the underlying portfolio drops 10%, a heavily leveraged CEF might fall much more. In late 2025, many taxable bond CEFs were using leverage in the 20 to 25% range, and some sectors even higher: price volatility and sentiment. Because CEF shares trade like stocks, their prices can swing more than the underlying assets, especially when investors panic. Discounts can widen dramatically during market stress, even if the NAV doesn't fall as much. That means you can feel like you're getting hit twice, once in the portfolio and again in the discount. Distribution cuts. That sweet 9% distribution is not guaranteed. Funds can and do cut distributions if income drops, borrowing costs rise, or management decides the payout isn't sustainable. When a fund cuts its distribution, the market price often drops as income-focused investors bail out. Return of capital confusion. Some funds label a portion of their distributions as return of capital. Sometimes that's tax efficient, basically giving you deferred taxable income. Other times, it can mean the fund is just handing you your own money back, shrinking its asset base. You have to look at long-term NAV trends to see if the distribution is supported or if the fund is slowly cannibalizing itself. Fees and complexity. CEFs are actively managed and often charge higher fees than simple index ETFs. You're paying for that active strategy, the leverage management, and the structure. Plus, the whole discount/premium dynamic adds another layer of complexity you have to monitor. So no, closed-end funds are not a magic machine that prints 10% a year without risk. But for informed investors, they can be a powerful tool if you know how to separate a sustainable cash flow engine from a ticking time bomb. How a CEF fits into a real-world income plan. Let's make this concrete and talk about how an American investor might actually use CEFs. This is not financial advice, but think of it as a framework. Imagine you're in your 50s or 60s with a 401k and slash or IRA built up over decades, maybe a taxable brokerage account, a goal to turn your savings into reliable monthly income in retirement. Your traditional options: a broad U.S. stock index fund yielding maybe 1.5 to 2%, a bond ETF yielding 3 to 5% depending on the mix, maybe some individual dividend stocks yielding 3 to 4%. For many people, those yields alone won't support the lifestyle they want without selling shares. That's where some investors carve out a portion of their portfolio, say 10 to 30% depending on risk tolerance, and allocate it to high-income vehicles like CEFs. Here's how they might think about it. Keep a core in broad, lower-cost index funds or diversified ETFs for long-term growth. Use a satellite bucket of carefully chosen CEFs to boost overall portfolio income. Focus on funds with reasonable leverage, sustainable distribution histories, and attractive discounts relative to their own past. For example, say you have a $400,000 portfolio, $300,000 in broadly diversified stock and bond funds, $100,000 in a basket of CEFs with an average distribution rate near 9%. That CEF portion alone could potentially throw off around $9,000 per year in cash flow, about $750 per month before taxes. Combined with dividends from your core holdings and possibly Social Security or other income, that can meaningfully move the needle. The point isn't to go all in on closed-end funds, it's to use them like a high-octane income layer on top of a solid base. The mistake is treating them like a savings account. A simple checklist before you buy any CEF. If you're still watching, you're probably thinking, okay, this is interesting, but how do I avoid the junk? Let's walk through a simple checklist you can apply before putting $1 into a closed-end fund. Look at the discount or premium. Is the fund trading at a discount to NAV? How does today's discount compare to its own long-term average? You generally want funds where the current discount is wider than normal, not ones trading at a big premium. Check the distribution rate and history. What's the current distribution rate at the market price? Has the fund maintained, grown, or frequently cut its distribution over the years? Long or stable histories are more reassuring than funds that slash payouts every few years. Understand leverage. How much leverage does the fund use? 10%, 20%, 30% plus? Are you comfortable with that added volatility and interest rate sensitivity? Higher leverage can mean higher yield, but also sharper drawdowns when markets fall. Study the underlying assets. Is it mostly bonds, loans, stocks, munis, preferreds? Is this an area of the market you understand and are comfortable owning? Remember, CEFs are wrappers. You still need to like what's inside. Check if distributions are covered. Is the fund earning its distribution through income and gains, or is it heavily relying on return of capital? Has the NAV been relatively stable or steadily eroding over time? A slowly melting NAV can be a red flag that the distribution is more show than substance. Know yourself. Can you stomach watching the market price swing more than a basic ETF? Are you going to panic sell the first time the fund announces a distribution cut? High income doesn't matter if you bail at the worst possible moment. Most people spend more time researching a $1,000 vacation than a $100,000 portfolio. If you spend just an extra hour with a CEF's fact sheet and history, you'll already be ahead of most yield chasers. Why Wall Street doesn't lead with this. So if closed-end funds can offer 8% plus income and trade at discounts, why aren't they front and center in every brokerage commercial? A few reasons. They're harder to explain, but it's much easier to sell. Here's an S&P 500 ETF, it just tracks the market. Discounts, premiums, leverage, NAV, those take more than a 30-second ad to explain. They're a niche market. CEFs are a smaller slice of the investment universe. Big firms make enormous money pushing mass-market mutual funds insurance products, and set-it-and-forget-it strategies. CEFs often appeal more to self-directed investors and specialists. They require ongoing education. Discounts change, leverage changes, distributions change. Advisors who use CEFs effectively tend to be the ones who specialize in income strategies and are willing to keep clients educated about the moving parts. That's harder to scale than just dumping everyone into target date funds. In other words, CEFs live in that awkward space that's incredibly useful for informed individual investors, but not super convenient for Wall Street's marketing machine, which is exactly why digging into them can give you an edge. Final reality check. And your next move. Let's be brutally honest, closed-end funds will not turn $5,000 into $5 million overnight. They will not protect you from every market downturn, and they absolutely can blow up your finances if you chase yield blindly and ignore risk. But used wisely, they can do something most Americans desperately want: turn a chunk of their savings into a meaningful, recurring income stream without having to become a landlord, a day trader, or a full-time options gambler. So here's your action plan after this video. Step 1. Log into your brokerage account and search for the closed-end fund section or CEF screener. Step 2. Pick just one fund to study in depth. Look at its discount, distribution history, leverage, and NAV trend. Step 3. Ask yourself, if this were paying me 8 to 9% a year, would I still sleep at night knowing how it works? If the answer is no, move on. If the answer is yes, you might have found a candidate to add to your income toolkit after you do your own due diligence and, if needed, talk to a qualified professional who understands these structures. Now I want to hear from you. Would you rather have a portfolio that might be worth more someday, or one that deposits real cash into your account every single month? And what's your personal yield target? 5%, 8%, 10%? Let me know in the comments. If this breakdown of closed-end funds opened your eyes to the 8% plus income world that most people never hear about, hit that like button so more people can discover it. Drop a comment telling me whether you've ever owned a CEF or which ticker you're curious about. Share this video with a friend who's stuck in low-yield funds and wondering how they'll ever retire. And of course, subscribe to the channel and turn on notifications, because in future videos, we're going to dive into specific funds, real-world portfolio builds, and the other hidden income strategies that Wall Street doesn't put on the brochure, but that could change the way your money works for you.